Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. And on this episode, very new to the Dividend Twitter community, you can find him on Twitter at DivObsession. And Troy, I'm going to throw it over to you to give yourself an introduction.
Yeah, hey guys. First, Dave, thanks for having me. I'm really excited to be here. Weirdly enough, I've recorded like 100 and something YouTube videos, and I'm still nervous. So hopefully that goes away. But yeah, I'm really excited to be here. I've been dividend investing for almost 3 years. Middle of 2020, the Rona period is when I
Yeah.
started. So yeah, I'm really excited to be here and see what we drum up in conversation.
Nice. That probably was a great time to start. If it was after March of 2020 when a lot of stock prices dropped and then we're starting to climb back up, so you probably got into quite a few positions at a great price.
Well, in theory, yes, because that would be, assuming I knew what I was doing when I started, which is never how it works. So literally so that's one of the things I wanted to actually ask you about too. So when I first started, it was on Robinhood. Everybody loves Robinhood. So I was on Robinhood. I was going through the process, and what literally how I picked my first stock was I went through the biggest winners and losers of that day, and I just clicked on the one that was at the top because, of course, if it went up 30% in one day, it'll go up 30% the next day, right? Not how it works. So that's the one I bought. It did really good for like a short week period, but then quickly not really good. So yeah, you live and you learn. So it's really important to get those lessons. You're not going to know everything when you first start, but it is really important to get started. Realize you're probably going to lose some money, but realize there's a potential to make a lot of money too. So
Couple of great points there. Just get started, and I've said it so many times. I call it my Moneyball reference. Just get on base. Just get started. You're not going to hit a grand slam, at your first at bat, but you just get on base any way you can. Just get started. Another great point you made there is we all make mistakes in the beginning, and you're going to learn. You're going to learn from those lessons. Well, hopefully you will.
yeah.
Well, yeah, you will. Guaranteed you will. And yeah, so, that's just life also, not just in investing. We learn from our mistakes. And then another great point you made there towards the end was, you're going to lose some money probably in the beginning. Sure, most of us all have lost money. But you start to look at that long-term mindset, and that's obviously what the dividend investing community is all about. That long-term mindset, that snowball, that brick by brick, just adding a little bit more every month, every paycheck, whenever you have an extra, whatever it is, 10, 25, $100, just keep adding it in there.
Yeah, yep, I completely agree. So, like, I did want to ask, like, do you remember when you first started, like, what your first holding was, or your first mistake you made?
Yeah, I mean, I'm pretty old, so it's hard to remember everything. um, so I've talked about this when I've been guest on other podcasts. I've been on Brandon's podcast, the Green Candle IT, and I've been on Harris's podcast, One Penny at a Time podcast. Go check those out if you want to really learn about all of my mistakes. Um, one of the first companies, well, actually, the very first company I ever bought, it was called FCT Fuel Cell Technology. I put like $40 or maybe $60 into it, something like that, and I knew very little about it other than, oh, this sounds really cool, fuel cell technology. And this is going back like over 20 years now, I think. Uh, Probably around 20 years ago because it was when online banking and you could start to trade um, online through your bank. So yeah, somewhere in that 15 to 20 years ago time frame. And one of the only reasons I bought it was because it was headquartered in my hometown. And again, you don't know what you're doing when you're beginning, right? And so anyways, yeah, that quickly, went to 0 and I lost the 40 or $60. So it wasn't like I lost 40 or 60 grand, but still, right?
And
Losing
it's
money is
always
no fun.
important to like you said before, like, drag out the lessons from that. So what you learned is, like, just don't buy companies because 'cause they're where you live, and also don't buy companies because their name sounds cool or their ticker spells something funny. Like, that's
Right.
that's something a lot of people, they're like, "Oh, this is a funny ticker, like, I'm gonna buy that one." Like, there's more to it. Yeah, so
Yeah, exactly. And then obviously from there, I started making uh, wiser decisions, but still making mistakes along the
Mhm,
way. I mean, to this day, I still make mistakes,
mhm.
but we all learn from our mistakes, or you would better learn from your mistakes.
Yeah, yeah, exactly. And yeah, I mean, it's just really important. Like, it's one thing to make the mistake and move on, but it's another thing to like pull back and reflect on that mistake and realize what made it a mistake in the first place. Sometimes it's literally, the CEO does something wild, the company goes downhill from there. You never would have saw that. But then other times it's there's things you could have looked at the whole time to notice that
Yeah.
this was going to happen and know not to make that mistake again.
Yeah, so I think great point you just made there is like, learn from it, but also move on. Don't
Mhm,
dwell on it because
mhm.
like if you dwell on it, that's just bad for your mental health and everything, right? Like,
Yeah. When they always talk about what's that phrase like holding onto the rope too long sometimes causes more damage than letting go of it in the first place.
right. Yeah.
Yeah. So, but yeah,
Cool.
okay, so then the next thing I wanted to quickly bring up if we could is do you remember the first stock that you so I when I first started investing, I think everybody's goal when they invest is to start with a little money and make it into a lot of money, right? So, do you remember your first dividend stock? Like if was it on purpose that you bought it? Do you still have it or how did that work?
No, I don't recall exactly because so again, I talked about sort of my whole life story on those other 2 podcast episodes with Brandon and Harris. And again, so this is going back somewhere around the 2007 to 2009 era, and I'm quite sure I had some oil and gas stocks that were non-dividend paying, and I think I probably had a dividend payer in there somewhere as well, and not really didn't really think about it. Um, and then it's just been more recently these last few years where I've gotten more seriously into the dividend investing strategy and just having that passive income come in every month or every quarter, whatever it happens to be. So, I don't think that really answers your question because no, I don't really remember.
Yeah, no, I mean, it's hard, like you said, it's hard with when you started so long ago. I have a quick story on my I don't like it's one of those things like the further you get away from the story, the less the details make sense. You're like, "Oh yeah, I
Right.
vividly remember this," but then it doesn't make sense. So what I vividly remember was on a weekend. So this is again with Robinhood, and when they had this program, when you signed up, you would get like, or when you first signed up, you'd get a free stock or whatever. So the free stock I got from Robinhood was Sirius XM Radio, and they are, let's just say, not a high quality dividend stock, but they are a dividend stock. So I think they've been
Right.
paying a penny for a very long time just to say they pay a dividend. But nonetheless, the story I remember is I was outside pulling weeds out of my front flower bed, and I got a buzz in my phone, and I looked down, and I was like, Sirius XM paid you 1 penny. And I was like, what the heck is Sirius XM paying me a penny for? And then I just started to look into it and I opened the app and I was like, oh, this is a dividend. I was like, what the heck are dividends? And then I fell down, that rabbit hole. And I think every dividend investor when they first start, they go through the path and the process of like, how can I get as much of these as possible with as little money put in? And that's where you fall into these yield traps. And you really,
Yeah.
really, as a new investor or as an experienced investor, really need to be careful with that. Cause I see so many people, I'm part of tons of groups on Facebook. That's actually where I know Jeremy. Jeremy's the one that, put me on with you.
Yep.
Um, and there's so many younger folks in those groups where they're hitting 13, 15, 20% yields and I'm like, guys, like this is fantastic that you're making that money, but like I don't think it's sustainable. Again, not professional advice. It could be. I don't know. Who knows? But history would say it's not. And so I was looking yesterday. So on my, like you said, I'm very new to dividend Twitter. I like to post the like increases and decreases from Seeking Alpha. I just go in there and I just put them out there for people to know. And then if I have one of those stocks like yesterday, NextEra Energy raised by 10%, gotta love it. 10% for nothing. I
Yep.
love that. I don't get a 10% raise at my day job, but I work there. So yeah. So I post those. And the one thing I'm really curious about, and I started to do a little bit of research on it, is I wonder what like if there's a yield bracket somewhere that says if your stock falls within this percent yield, it's more likely to get cut than not. Like basically looking back at history, because there's a lot of stocks that yield, 0.5%, 1%, 2%. I don't think I see a lot of those get cut. Yesterday, when I posted a couple dividend cuts, the yields were 10, 15, 20%. There was one that was on there, it was like 67% yield. I was like, I didn't even know that was a thing, but
How's that even possible?
yeah, that's ridiculous. But like, so it's one of those things. I just wanted to like, anytime I find those research points, I'm always just like, oh, there's always more I can dig into this. So it's very time consuming to be in my head, but nonetheless.
Yeah, so the yield trap, interesting point there. Like, I think everybody looks at that 3 to 5, 3 to 6% yield going, okay, that's quite safe. There should be room for dividend growth. And like you mentioned, there's no better feeling than seeing a company raise their dividend and give you a raise that you didn't ask for. And you're like, thanks. I didn't have to go and
I
have a
didn't have to get
conversation
nervous in
with
the
my
boss's
boss about
office.
why I deserve a
Yeah.
raise. They just
Yeah.
handed me this 5 or 10% raise or whatever it is.
Yep.
And then I also kind of moving into the REIT sector, a lot of my REITs are in that 6 to 9% yield, which I for that sector I feel is safe because REITs are in the real estate where they have that monthly income from their leases and rental properties and whatever. So and obviously the structure of a REIT too, so that they're able to have that little bit higher yield. So yeah, that I still find even up to 9% to be safe within the REIT sector. And then, yeah, I agree with you. When you get over that 10%, you start going, okay, how sustainable is this? Is there or when will there be a dividend cut? I do have one that's a very high yield, but it's an ETF and it's a covered call ETF. So that again, a little bit another different animal. So
Mhm.
uh, I guess lots of different things to think about and ways to look at it. But yeah, I would recommend to those people in your Facebook groups. Again, not financial
Yeah,
advice,
yeah,
but
yeah.
but take a closer look at those companies that are paying, um, those 13, 14, 15% yields because, yeah, you need to
Well, yeah,
do
and
your own due
they'll have
diligence.
their portfolio average yield is like 15%. So I'm like, they could have one of these little for every, 1 share of Apple that they hold, that just destroys their yield because Apple's yield's really, really low. So that means like they must have something else in there that's wild that keeps their average that high. And I'm just like, man, like,
Right.
I comment on there and try to do what I can. I'm just like, hey, one thing I always try to make sure people understand is their time horizon. I've heard several other YouTubers and other conversations where they talk about this. Like, it's really important. Everybody likes money, right? Like, that's especially the dividends, the passive money. That's the best part.
Yeah.
But you have to realize that, like, one thing I try to explain to people is like in the dividend world, just how much you make by dividends does not justify how much you know or don't know. Like you can have somebody that's just starting out on their journey. They're doing a really good job of picking high quality dividend companies and they're only getting paid out $3 a month. That doesn't mean they don't know as much or more as the guy that's making $300 a month. He just has more capital in or more time or all the above. So
Right.
you really need to understand like in the beginning, at least in my opinion, in the beginning of your journey, it's really important to focus on like the total return, the dividend growth rates, that the yield matters a lot less because you don't need that money now anyway. You're just dripping it. And a lot of people are like, okay, I want to drip more money versus less money. That's the argument for higher yields. But if the capital appreciation of your stock is going down and they're replacing it with, say it went down 100 or $100, the stock price did, but then they give you $75 in dividends. A lot of people just lose track of that. They're like, "Oh yeah, I made $75 in dividends, but you lost $100 in stock price." So
Right.
it's one of those things you really like. That's my thing. My goal is to retire at 50. I'm 28. I have 22 years worth of compounding to help me go.
Yeah, you'll get
Um,
there.
yeah, so it's really just like my portfolio yield. If I look right here, is I'm sitting at a 1.76% current yield with a 2.03% yield on cost. And I have some higher yield. The only reason the yield's even that high is because I have Exxon Mobil and I have AbbVie in there. So both of those are higher yields, and they really don't fit my criteria as far like we could talk about that too. They don't fit my criteria, but I just had them both for so long, and they both have done very, very good in the last 18, 12 months. So I don't want to I don't want to get rid of them. It's one of those things, right? You're up like 100% on a stock. You're like, oh, it's going to go to 150. Then it goes down to 75. Probably should have sold at 100. So it's yeah, that's a
Again, you
hard thing.
can't time the market. Don't try to time the
Yeah,
market. It's
exactly. So But yeah, so I mean, it's one of those things. Like for every ExxonMobil or AbbVie that I have Nvidia, which is I don't even know how they can be called a dividend stock. It's kind of like that Sirius XM, except way more high quality. They pay 4 cents per year or per share per year. So or no, it's 16 cents per share per year, which is 4 cents per quarter.
Right.
So that's that one hurts when it comes in. It's almost like an insult when you're making 61 cents off of a quarter. You're like, oh, that's cool. But yeah, so that's just one thing I always try to make sure people understand, especially in those groups. I'm like, hey, I always ask them, I'm like, when do you need the money to live off of, or when do you wish that that money supplements your income in like retirement? And a lot of them are like, oh, I'm 22, 23, 24. And I'm like, hey, like, again, not advice, but like you might want to switch your focus to like understanding that the dividends you receive today don't matter as much as the dividends you receive when you need them.
Yeah, and when you need them in whether that's 10, 15, 20 years down the
Yeah,
road.
exactly. Because you can always have those higher growth, both in stock price and in dividend, and lower yields now. Let them grow, and then in 20, 30 years when you need them, you can maybe the yield will be what you're looking for, or you can sell out and put into one of those QILDs or whatever SCHDs, whatever you prefer for the higher yields. You can put it in there, and then you can have your money with at that 3, 4, 5, 10% yield that you need.
Right. Yeah, interesting take.
So, yeah, that's that's sorry to ramble there, but
It's
that's just I
okay.
see that on the Facebook groups all the time, and I'm like, man, not to say anybody's doing it right or doing it wrong. I'm just like, there's a smart way. Like I always say, like one of the tagline on my channel is dividends done different. Because
Right.
I just think, so I was actually getting into a debate on Facebook with this before. Is so this video right there, that making money every week, that's actually a video I wanted to talk about. I got that video done before this conversation because I knew I always see people sacrificing the quality of their dividend for something that does pay more frequently.
I will link
Where
this
they're gonna
channel in the description and make sure to do this. I purposely waited to do this. Click that
boom,
subscribe button.
look at that. There we are. Yeah. Welcome to the dividend obsession community. But yeah, so that second video right there, the making dollar every week without lifting a finger. So the point of that portfolio, that's using dividend growth. This is my style of I necessarily don't care about the yield. I care about double digit dividend growth rates and beating the S&P 500. Like those are my things. I want to make as much money as possible and I want that money to grow passively as quickly as possible. So that portfolio, there's only 12 individual quarterly paying stocks in that portfolio that I made. And the combination of all 12 will get you paid every week. So instead of these, I know there's an ETF out there called WKLY. It's an American ETF, and it literally pays weekly. I don't know the quality of it, but I'm being willing to guess it's not great. Just
Right.
because you are sacrificing, that frequency of payment versus the quality of the fund. So I really wanted to make something that those new investors would see, and they're like, "Oh, okay, I can buy high quality companies that don't necessarily pay me monthly or weekly in that case, and it still does the same job." So,
That's very interesting. 12 companies get paid every week.
yep.
I like that.
Yeah, so it's really cool. Again, I'm biased. I made it, but I'm actually so that one again is using the dividend growth rate, which is more my strategy. I'm actually like what I was doing this morning. I woke up at like 6 a.m. I've been working on one that's a higher yielding one. I think the yield of that portfolio is going to be 5% versus the yield of the one that we just looked at was I think is 1.64%, which is actually higher than the S&P 500 yields. I think S&P is at like 1.59. So it's still higher than the market, and it has a 14, I think it's 14.87% 5-year dividend growth rate is the average of that portfolio, which is ridiculous. And then yeah, this one that I'm working on right now has a 5% dividend yield average throughout the whole portfolio. I haven't ran I'm not done with it yet, but I wanted to get that yield out there because I knew though there's people that care more about the yield. So that portfolio should go up on Monday. It takes a lot of time to get all that research done, but if I can get that done, I can record it and edit it, and it'll be out. So
Cool. So, yeah, like I said, I will link that channel in the description below, and I definitely make sure to check out the Dividend Obsession YouTube channel.
yes, I appreciate it.
Cool. Talk. Let's talk about some specific sectors and different companies. I guess sort of is there any one sector that you focus on?
Not really. So I do try to keep it diversified. So if I sorry, I'm gonna pull this in front of me so I'm not looking away. So it looks like I'm at 30% tech, which I don't like the percentages being this high, but where I'm at in the journey, I'm in accumulation phase. I only have 11 holdings in my retire early account. So so it makes it a little hard to be really diversified because if you hold two companies in the same sector, it's going to be a big proportion just because there's not a lot of, not a lot of
Right.
split up there. So it looks like I'm 20% consumer discretionary, 8% energy, 8% industrials, 30% tech, 8% materials, 8% utilities, 10% healthcare, and 8% financials.
Cool. So let's start off the top then. That 30% tech. Apple, Microsoft.
Are you looking at my screen? Yes, that's exactly who I have. So I have so in my tech, I have Apple, I have Microsoft, I have Nvidia are my tech stocks. Like I said, Nvidia, I should have probably held that one in my Roth just because it's the growth company. So that's what you try to put in there so you don't have to do the taxes thing. Um, but yeah, I have Apple, Microsoft, Nvidia. I try to keep so Apple is at 11% of this portfolio, Microsoft is at 11%, and then I have Nvidia at 8%. So that's how we get to our 30%. But
Right.
and I do a dollar cost average every day approach just because, like you said, trying to time the market is a losing battle. For every one battle, it's kind of like the lottery, right? For every one battle you win, you lost 100 to get there, kind of thing.
Yeah.
So I quite literally went through and I was like, okay, cool. Like I put in money at the end of the month to invest for the following month. I figure out how many trading days are in that month, and then I have a little bracket down at the bottom of my portfolio that shows like what percentage I want in each stock. And then it just splits it up by the number of trading days. Because what I was doing, I was like, okay, I want to invest every Tuesday, and then I was like, oh well, Tuesday happened to be a day where we're up 3%. I'm like, I don't want to buy on the green days. That's pretty lame. So and then I was like, okay, let me wait for a red day throughout the week. And then there was never a red day throughout the week. And then I missed all those gains. I was like, you know what? I'm going to split it up. If there's 20 trading days, I'm going to say I have $500 to put in this stock. I'm going to divide it by 20, put that much money in that stock every day. Just call it a day. Don't overthink it. Just put it in there. Typically do it on my lunch break. Just, take 10, 20 minutes, go in there, just buy each of those 11 stocks for how much percentage I need them. And then that's what I do. Just move on.
That's a great way to dollar cost average. Just literally every trading day, just put in your $25 or whatever that math works out to out of the 500. And yeah, that's a very interesting strategy.
Yeah, it takes the emotion out of it, right? Like what's the Warren Buffett quote? Like the stock market's like a voting machine. Like the long term is where you want to be, but the short term's like the emotional, like, oh, this one's up 3%, down percent, whatever. So quite literally, I just try to, and it helps me keep my portfolio balanced every day too, because I'm constantly, as I buy a stock or as a dividend goes in there with the drip plan or whatever, it factors all that in, and it's
Right.
like, hey, you want Apple to be at 11% of your portfolio. I just got a dividend from Apple, so it'll factor in like, okay, we're gonna put a little bit less in this one because you got that free money the other day. So it does all that. The only sad part for me and my investing style is I currently work to max out my Roth IRA first. I try to get that maxed out as soon as possible in the year. Last year I got it maxed out by April 5th. And then once I get that maxed out, every money from that point forward goes in this retire early account. But I do want to take advantage of that Roth, get it done, get it maxed.
Right.
So in the beginning, the first like 6 months of the year, this portfolio, my retire early account just kind of sits and operates on its own. And then the Roth IRA is just getting money, 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 like as quickly as I can put it in there. And then once that's done, like I said, I obviously can't fund the Roth anymore, and all that money goes to the retire early. So
Cool. And then let's just go down your portfolio. The 20%, did you say that was consumer staples or was that something else?
I have 20% in consumer discretionary. I know you like to lump them in often. So, I mean, yeah, it's the same thing. So those stocks in consumer discretionary, I have Pool Corporation and Starbucks are my two consumer discretionary stocks.
Yeah,
They're
let's
both
talk about Starbucks. That is an
I
amazing company.
I love Starbucks. I actually just had a friend on Facebook post. She posted something about like, oh, this is what happens when you work right across the street from a Starbucks, and she took a picture of it. And I was like, I appreciate your contribution. I'm a
Yeah.
shareholder, so it's one of those things. I can't fathom spending that much, but they have some product in their coffee that they can't tell us about, but it's very addicting to most people. Some people call it caffeine, some people might call it something else, but there's something in there. People will spend whatever they want to charge for Starbucks. And I was just watching CNBC the other day, and they were talking that China accounts for like I think it was 16% of their sales, but it's only 9% of their locations. And now China's opening back up. So like that's going to be a boost in revenue that Starbucks didn't have last year, the year before that. So
Right.
yeah, they're a great dividend grower. They're not too high in yield. It looks like they're right now around like 1.95%, like almost that 2%. So it is low. It's pretty, it's around my portfolio average, but I don't really care about that. I just care about that dividend growth rate. Every year they're giving me a double digit raise and they beat the market. So that's really what I try to focus on there. But yeah, I love I don't go to Starbucks. There's one right on the corner by a red light by my house, and they, for whatever reason, Starbucks never makes their parking lots big enough because there's always cars in the street, like getting in there.
Yeah.
I'm just like, this is ridiculous. So yeah, great company to have. I love Starbucks.
Yeah, yeah, I agree with you. Like when people are going and spending 6, 7, $8 on a coffee, they're doing something right, and they're always busy. All their locations are always busy. So,
It doesn't
as
matter
I
the
don't
time
own
of day or
Starbucks.
nothing.
Pardon me?
I've seen Starbucks busy at 11 p.m. I'm like, don't you people sleep?
Yeah. How are you? Yeah, exactly. Like you're drinking caffeine at 11
Yeah,
o'clock at
yep,
night.
yeah. I don't know. Maybe the unicorn sprinkle frappuccinos that they're getting aren't that rich. I don't know. I don't know. I don't go in, but I just appreciate all the other people that do. So if you're a
Yeah,
Starbucks
exactly.
consumer, thank you. So
Yeah. Um, I don't go to Starbucks too often or hardly ever. I think there's only one here in town that I know of, and it's in a bookstore, and we called it's a Chapters bookstore. So obviously, the Canadian market is way different than the U.S. market. We have a lot more Tim Hortons here, and obviously that's sort of the biggest competitor to Starbucks, and the coffee is a lot less expensive than Starbucks. So, yeah. So there's a with that said, Starbucks still does amazingly well in the Canadian market, right? In the bigger, like I live in near a relatively small city, so in the bigger cities, obviously there's tons of Starbucks. Like
mhm.
I'm sure in Toronto there's hundreds, if not thousands, of locations of Starbucks, right? So
Yeah. It doesn't matter. Like, you can go in the city, you can go in the mall, you can go in the airport. Like, there's a Starbucks everywhere, and it's just, they're especially when you can get into places that are restrictive like that, like the airports. That's
right,
really big because you don't have options. It's not like you're gonna leave the airport to go get a different coffee. Like, you don't have any options. Like, you're going to Starbucks.
yeah,
I mean, obviously, if there's a McDonald's or something there, you can, get a McDonald's coffee, but people like to tote that Starbucks logo around. They're like, I got Starbucks. So
yeah, cool. And let's just keep moving down. What was the next percentage you had there in your portfolio?
next would be healthcare at 10%, and then everything else is pretty much equal at 8. So healthcare, I think the only stock I have in a healthcare is that AbbVie. I that's one that I don't know. So I have a tab on my spreadsheet called philosophy notes. And it's just making sure that these things, because I wanted to justify to myself why I bought a certain company. Because a lot of people do that, right? Like, especially if they go on YouTube, they look up somebody's video, they watch something, they don't do their own due diligence, and they just buy it because
Right.
they have less conviction about that stock, right? So if it goes down, they're like, oh, I shouldn't have listened to so and so. Like, that's why it's important to do your own due diligence. Because if you can go through, it's a completely different feeling when you buy a stock because you wanted to buy a stock and it met whatever metrics you're looking for. If it goes
Right.
down, as long as those metrics and like the ideology behind that reason you bought that stock didn't change, you're all in. You're like, if I like the stock at $60 a share, I love it at 55. I love it at 50. I love it at 45. So it's kind of one of those things. Again, that helps with the dollar cost average because I know a lot of people that are like, oh, this stock is down 5% today. This one's up 1%. I'm going to put my money in the one that's down 5%. That your portfolio just gets quickly out of balance when you do that. So I just try to put money in there all the time because if you wait for certain stocks to drop, they just never do. And then you just miss the boat. So you're just
Yeah.
like, oh, I'm going to wait for AbbVie to go down. Well, plot twist, AbbVie doesn't go down. It seems that AbbVie's just up and to the right the whole time. So if you're just waiting for that, you're just, never going to buy it again. So
Yeah, it's easy to miss the boat when you're really trying to dollar cost average down. Sometimes you just have to realize, okay, hey, pick a number. Let's say, like you said, at $60. and you want to buy it at 55, but all of a sudden it's up to 65 or 70. Well, then you're
Yeah.
going, well, I guess I should have bought it at 60, right?
Yeah,
So
and then now you're waiting for it to drop to 60 instead of just buying it at 60 and then getting that, $5, $10 per share gain. So yeah, it's a struggle. Like I said, the dollar cost average has been really kind to me just because I do overthink everything. I call it appropriate thinking, but everybody else says it's overthinking. But so yeah, I do that, and it's just so much easier. The hard part, like I told you, I overthink everything. The hard part for me is I'm like, oh, the markets are down a lot first when they open. I'm like, should I buy it now or should I wait till lunch or should I wait like if it keeps going down throughout the day? I'm like, oh, should I wait until the very last minute to buy my stocks? Or and at the end of the day, I'm just like, just buy it at lunch every time. Like you might
yeah,
miss a little bit of here. I think it was either Friday or Thursday. The markets were like trending up and then all of a sudden like went down like a good bit, like right before the end of the right before close. And I'm like, man, I missed a little bit, but like if it's still down there tomorrow, I'll buy it tomorrow. So really taking the emotion out of investing as much as possible is very beneficial. So
yeah, I kind of do it a similar way where on say a payday when I want to pay myself first, and I'll transfer um, whatever it is for that pay week, whether it's 50, 100, $300, whatever, transfer it into my brokerage account, and then just when the markets open in the morning, 9:30, 10:30, when I kind of can have a little break, get on my phone and just buy what I want to buy without again exactly without overthinking it. And I usually do go, kind of scroll through my portfolio a little bit, say, and look at what I can dollar cost average down on that
mhm.
particular week, and be like, okay, well, this particular company I can dollar cost average down, so I'll buy 5 shares of that or 10 shares or whatever, right?
Yeah.
So and but kind of very similar thing of trying not to overthink it too much.
Yeah, and I mean I know a ton of people that do that. The strategy of like which one's down the most because like that's another thing that a lot of new investors one of the metrics they don't focus on is their cost basis. And like understanding how that works, like basically like if you bought a company at $100, you bought the same company another share at $50. Now your cost basis is 75, and if it goes back to $100, you made $25 per share.
Right.
So a lot of people don't understand like the math on that, and it's just really important. Um, Anytime like dividends, another thing that's so great, man, I could just go on and on about all the things that are great about dividends. But one of the things that's great about dividends is um, it's a win-win game, and most things in life aren't win-win. So like if say I open up my portfolio on Fidelity. Monday the markets are closed, so on Tuesday, and everything's down 90%. A lot of people, especially if you're not a dividend investor, like, oh my gosh, I just lost 90%. I'm like, it's time to buy. What are we
Yeah.
getting? Like, I'm getting all this stuff because they're still like, because my companies, the payout ratios are really low. Their dividend streak is at least 5 years or more. They have a dividend growth rate of north of 10%. All those things, like they're not going anywhere. Apple's not going anywhere. Microsoft's not going anywhere. Visa's not going anywhere. Starbucks isn't going anywhere. Like all these companies like that. When they go down 90%, same thing I was telling you before. If I like the stock at $100, I love it at 10. I can buy
Yeah.
so many more at 10.
Yeah.
And then on the flip side, I don't like seeing green days as much because I'm in accumulation phase. I don't care what the stock price is now. I just need it to be a lot when I'm 22 years from now. That's what I need. It
Yeah.
can be 4 cents now as long as it's $500 in 22 years. I don't care. So it's kind of like that's what I mean by the win-win. Like if the markets are green, I'm making more money on the stocks I have in there. Yeah, it's costing me more today than it would have yesterday to buy that same amount. But I made money on the stuff I have in there. And if it's red, I lost some money versus what I had yesterday, but now I'm getting things on a 1, 2, 3% discount. So that's how I look at it.
Yeah, I would even say it's a win-win-win. So the two wins you point out of being able to dollar cost average down on red days and the capital appreciation on green days, but the third win is they keep paying you every
Yeah,
month or
yeah.
every quarter. That
Every
dividend,
yeah,
just
every
like
time. Yep.
here we go, thank you.
Yeah.
Just I love it when companies pay me to not work for them. It's like one of my most favorite things in the
It
world for
it
sure.
almost so when they tell you, if something's too good to be true, it probably is. This is too good to be true, but I mean,
Yeah,
Warren Buffett's been doing it for a long time, so I don't that somebody hasn't figured out how this doesn't work, but until then, I'm gonna keep doing them. I love the dividend, so.
awesome. And then I think you had like three more sectors there at 8% each. So let's just dive into some of those.
Yeah, so any energy, industrials, materials, utilities, and financials are all at 8% each for me. So the materials is air products and chemicals. That was a buy. That was actually one of the YouTube videos I watched. But I did my own due diligence. It was because he was bringing up all these good points about it, and especially during the COVID times with the filters and stuff that all these businesses were going to be buying to make sure that they could return to office. So they're very very good. That's at 8%. Industrials, I have Illinois Toolworks, just a solid, boring company that just meets all my you would never guess that a tool place, I mean, they do a lot more than that, but a tool place beats the market. They increase their dividend by 10% or more. That like they just meet all the things. They've been paying it for a long time. Like one of those things. Typically, boring's good, especially here. You don't want to be in the news all the time because people will tear you apart in the news cycle. So, yeah, Illinois Tool Works. Next Era Energy, like I said, that's my utility company. They just increased me by 10%. Gotta love it. People always need electric, so
Yeah.
so you're not going anywhere without that. Now you're going more into solar and stuff now, but that's not going to be a tomorrow thing. That's not going to be a 5 years from now thing. That's going to be a 20, 30 years from now. We'll see how many solar panels are on roofs and stuff. But and then yeah, financials is Visa. I get how Visa's a financials. I kind of want to call it something else other than that, but I mean that's how it was listed online, so I just call it financials. And then Exxon Mobil's by energy. So again, oil's not going anywhere tomorrow. So, so AbbVie and Exxon more specifically is the one that really doesn't meet my criteria. So my criteria that I break down my stocks by is you have to pay a dividend for at least 5 years in a row. You have to beat the S&P 500 with dividends reinvested over the past 10 years. Because at the end of the day, everybody's goal is to make the most amount of money. If I can take the risk to buy individual stocks that are beating the market, then that's worth it. If I'm taking the risk to buy individual stocks that don't beat the market, why didn't I just buy the market? Like my goal is to make the most amount of money anyway. So the market would have made me more money. I would have been better to do that. And then the last thing is either a 3, 5, or 10-year dividend growth rate north of 10%. I prefer the 10-year just because that's, longer duration. But if I can get a 5-year, I'll settle for that sometimes. And I think ExxonMobil is the one that doesn't fit that with their dividend growth rates. I think their dividend growth rates are somewhere around like that 4 to 6%. But that's one I held like my yield on, so the current yield for ExxonMobil is 3.14%. My yield on cost is almost 5. So it's one of those, that was one of the ones I've had since COVID. And I got lucky. For every 10 stocks I bought that were terrible, ExxonMobil was one that stuck. So I've had and that's one that does hurt, like you're saying. I do dollar cost average into that one. And every day I buy it, my cost basis goes up a little bit. I'm like, oh, I had a cost basis of like $45 at one point on ExxonMobil, and I think it was 45. Somewhere really, really, really low, and now it's creeping up. I think my cost basis right now is 73.17, so it's still way, way lower than current price, but it's gone up
Right.
every day since I buy it. I'm like, oh, but
So I just want to say, I think going over your portfolio, you hold some great companies. You're well diversified, and having the time on your side because you're younger in your mid to late 20s. So like you said, you've got this 22-year time horizon that and so these companies that you've researched and done your own due diligence, and you've really looked at that, you know, the dividend growth and the potential for dividend growth over these next 20 to 25 years. So I think you're setting yourself up for a fantastic future, continuing to dollar cost average into all of these. So, you keep building that snowball bigger and bigger, just adding those snowflakes every day. Going back to that one point you made about a 61-cent dividend or something, but I was just thinking, hey, but you know what?
mhm,
Every little snowflake makes
yeah.
that snowball a bit bigger, right?
Oh yeah, I still buy it. I'm like, yeah, hey, we're gonna get this to 62 is what we're gonna do. So yeah, it stinks that it's so small compared to like I'll get a almost $30 check from AbbVie, $25 from ExxonMobil. Like that's per pop. So we're getting
Right.
that, and then here comes little old Nvidia giving me 41 cents. I'm like, oh, we're getting there. We're doing it. We're doing a thing. So yeah, it's just it like I said in the very beginning, getting started. I try to ask as many people that don't invest in the stock market. So I don't know how it is up there in Canada, but like I think a stat was that it's either 49 or 51% of people in the United States are not invested in the stock market in general. And that's including 401ks, which is really terrifying.
Right.
Cause like they're just relying on we have social security. They're going to rely on that. But like every year, they push it back, 2 years or whatever. And they try to, with inflation, what are prices going to be in 30 years? Are we going to have social security in 30 years? So like you have to plan this stuff for yourself. Like you don't want to rely on anybody else. You want to rely on yourself and the decisions you make now to help you 10, 20, 30 years from now. So,
Yeah, so we have similar things here in Canada. One's called a CPP, which is a Canada Pension Plan that you start paying into every single job from the time you first get a job when you're 15 or 16 years old, and then another one called OAS, which is Old Age Security. And the problem, like, it's great. Those when you get to the age of say 65 to retire, and you can start collecting those two things. Those two should be your bonus, not what
mhm.
you're relying on. And
Exactly. That's my plan with I have my taxable account. I want to retire at 50. If I can get to 50 where I can live off of the dividends from this account, that'll carry me to 59 and a half. At 59 and a half, I get access to my 401k, my HSA, and my Roth IRA tax free, or penalty free, I should say.
right,
And then from 59 and a half, so I was already able to live from 50 to 59 and a half comfortably. And now I'm getting those three accounts, like calling in the reinforcements. They're going to just boost me up even more. And then once you hit 65, 67, 70, whatever it is by the time I'm old enough, that'll just be more reinforcements. Just like you're saying, like you shouldn't too many people rely on that stuff. And I'm just like it'd be nice to have kind of thing. Like I don't need it. I don't need to rely on anybody. But if the government wants to send me $600 a month, I'm not going to say no. I can just add that to my dividends. So,
right.
but yeah, I agree.
Yeah, interesting points. Anything I know, before we started recording, you said, you had sort of some points, and I know we've covered some of them. You have anything else on your list of points that you wanted to talk about?
Yeah, so I mean, the first thing I brought up is it's kind of like what got us started. I told you guys the story about the Sirius XM paying me a penny that got me into dividends. I just wanted to go over like a funny story I have. So me overthinking everything like I do. I have spreadsheets on spreadsheets. I'm a big Thunder fan. I ironically enough don't have any. Oh, I have this little guy. I have my little Thunder Bear right there. But I'm a really really big Thunder fan. I have spreadsheets on the Thunder. Both of the games I've been to. I've been to like 207 games in a row. Home games that is. I don't travel with the team. That'd be
Yeah,
impressive. But yeah, 207 home games in a row. I live in Oklahoma City. And then so I have that spreadsheet to track like my fandom and how well we've done when I'm there. Like I'm some kind of lucky charm or something. And
yeah,
then I have spreadsheets for like the Thunder history, like how we've done since 2008 to now, like all kinds of stuff. So with that being said, when I first started my dividend journey, um, I basically on accident backwards calculated dividend yield. So I was trying to be efficient and I was like, okay, if I put $100 into this stock, how much will it pay me? And I was like, oh, this one's going to pay me 7 cents for every $100. And I didn't realize that I'm literally calculating dividend yield. Like that's so much easier to do is just use that. But I was just trying to be efficient. And I was like, okay, what if I did this portfolio of like, if I could put $100 into each of these stocks, this one would pay me out the most. But over here, I just had so many numbers. I often suffer from informational paralysis where I just want to know something, I learn something, and then I know too much, then I learn more things, then I don't end up making any decisions. So I that's when I came up with that segues into my next thing, like those three metrics that I was telling you about, the 5-year dividend streak or more, 10% dividend growth rate, and beating the S&P. The reason I chose those three is because they're easy to understand for everybody. Like you don't need to be an experienced dividend investor to understand those three metrics. They're easy to find, they're easy to understand. The other thing I've noticed, especially in those Facebook groups and just in the community in general, like everybody has their metrics that they're gung ho on. Um, but then there's always the caveat, like for example, payout ratio. This is the easiest one I can think of. Payout ratio in some sectors needs to be around a certain point. Like most people are like, oh, 60%, 70% or lower is like, safe. But then you get into REITs and REITs don't abide by that rule. The
yeah,
REITs are completely different. And so it's one of those things. For every metric you find, there's always a certain company or a certain sector that it doesn't work for. Or you'll be like, hey, I figured out the greatest metrics of all time. And somebody like, well, those metrics stink. And you're like, oh man, I've worked so long on these. And like this, I thought these were great. So that's when I came up with those three. That's been, I think I figured that out like the beginning of last year. So for the last year, any stocks I've added, they have to fit those metrics. Now I'll look into them a little bit more and make sure everything else is on the up and up. But like That's like my screener. I go through and I get rid of any stock that doesn't meet those things, and then I go from there. But yeah, it's all about keeping it simple like that. That's understanding my time horizon. If you're older or you do need the income sooner or now, then you might throw in yield there. Like, okay, it has to meet these metrics and have a 3% yield or something like that. And you just figure it out from there. But yeah, so those are my metrics, my process of backwards engineering dividend yield and stuff like that. So yeah, I mean, do you have anything to add to that?
Yeah, I wanna know how your team does when you're in attendance.
Well, turns out it doesn't matter if I'm if I'm there or not. It's about the same. So
50%.
OKC, we're in the middle of a rebuild right now anyway, so we're historically worse now than we have been. But we're on the come up. We're going to be really really good in the next year or two. So the cool thing is, like, everything I do or everything I enjoy in life, just it all lines up the same, and it's weird how that works. So I'm really big into fitness. I'm a power lifter. I'm a national level competitor.
Oh, wow.
And they, like, understanding fitness, how it starts small, you have to keep doing it for a long time to get these small incremental gains. And over time, you look back and you'll be like, wow, I'm benching 340 pounds. I remember when I was benching the bar. And it's the same thing with being in dividends. Same thing.
Yeah.
So that's actually leading, man, these segues are perfect. That leading into the next thing I wanted to say for like the new people, it's one very 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 important to track your progress throughout this time, because without knowing where you come from, you can't tell where you're going. Like, you have to be able to trend it. And it's also very important, while tracking your progress in the beginning, to focus on the things that are going to benefit you, right? Like, keep your mind sane. And what I mean by that is, like, in the beginning, focus on the percentage growth. You're only going to be making 10, 20, 30 cents, a dollar, however much a month, because you're just getting started. But if you make a dollar this month, and then the next quarter, that same month, you made $4, that's 400%. Like, you're
Right.
you're killing it. Like, if you can focus on that, and then once those percentages start getting smaller, you should be able to look right over to the side of it and say, oh, now the dollars are big enough. And then the dollars will keep you motivated. Because now, instead of making $4 a month, now you're making $400 a month. So that's one thing I've always tried to, like, explain to people. Like, the percentages are really good when the numbers are small. When the percentages get small, the numbers get big, and you can focus on that. So,
Cool, cool. I do also wanna just give a shout out to buyinvestingshirts.com. The link will be in the description. Use the code word posse. There is passive income posse merch as well, beanies and hoodies, and yeah, so I'll link that in the description. Head over there. They've got tons of really cool merch. And yeah, this has been an incredible conversation. Loved having you on here. And is there anything else you wanna talk about before we sign off?
um, I mean, yeah, no, that was basically everything I had. I had just 4 bullet points of stuff to talk about. Just tracking your growth, very, very important. You don't need anything crazy. You don't need to buy one of these expensive spreadsheets or anything. It's just literally, track how you made in January, whatever, and make it visual if you need it.
Yeah.
But it's just really important to track that stuff, because when you are new, when you are young, the numbers are going to be small. Don't get discouraged. It's all about starting. We all started in the same spot. Now I might have
Just get
started with
on base.
$100 and you might have started with $500. That's the same thing. But we all started making no money in dividends, and our goal is to make a lot of money in dividends. So,
Yeah, I would agree. I love my Excel spreadsheet where actually just this morning I updated it with because just this past week, obviously my monthly REITs went in and a few others, so I just updated it. And every company, whether you put $7 or $15 or 80 cents beside it, and then you see that total at the bottom, and you're like, I like that total. So,
mhm.
and then I have another sheet where it's my 10 year, so I have the 2022 and 2023 and up to 2032. So, and I just love that 10-year grand total that just keeps going up and up and up, right? And I'm really interested to see where that's going to be in 2032.
Yeah, I try to do the projections and stuff, but I'm having a hard time figuring out, like, how to freeze the projections, if that makes sense. Like, I don't want to, because every time I update my numbers, all my projections change too. So it'd be really cool to be like, okay, in January I was projected to get this much this year, and like have that number saved somewhere. Haven't figured out if that's a thing in Excel or not. But then like in July, let's see where it's at now. Like, oh, I was projected to get this in January. Now I'm projected to get this because I've added money or I've gotten dividend raises or the drip or whatever it is. So I mean, I'm always, like I said, I overthink everything. So I'd always like to have more information than I have. My spreadsheet started with like 2 or 3 tabs. Now I think I have like 13 or 14 tabs. Just every time I'm like, oh, this would be a cool thing to track. Like I was watching one of your podcasts the other day where somebody on here was saying that they track their monthly expenses on their spreadsheet. And then they're like, oh, okay, I can go through this time. And I'm like, okay, now it pays my Netflix. And now it pays my Netflix and my Spotify. And then now it doesn't pay my Netflix and Spotify anymore, but it pays my cell phone bill. And then,
Right.
like, as you can increase that, and you're just like, eventually it'll pay for just your mortgage, but then it'll pay for your mortgage and your Netflix. And then that's how you can quickly see, hey, this is a thing. Like, I can do this. Like, this is going to get me somewhere. So, there's a lot of that. It's very important to track, like I said. And then another thing, I don't know, maybe you guys surround yourself with better people than I do, but there's a lot of people um that they poo poo on the dividend game, right? Like you're like, oh yeah, you put in all that money and in 30 years you'll have 46 cents. Like that's what they always say. But it's again starting because the numbers are small when you first start. But then it's also going to be one of those things. I get this in fitness all the time. They're like, oh, how'd you get so strong so quick? It wasn't so quick. I've been working out for 10 years already. And it's the same thing with your dividends, right? You're going to build this portfolio. And then all of a sudden, when you're just sitting on a beach and you're like, oh, Apple just sent me $800 check. They're like, how the heck are you getting $800 from Apple? You're like, oh, remember when I was getting 46 cents? Now it's $800.
Yeah.
So,
So, great point there. There's a few people on Twitter that everyone in the dividend Twitter community knows. Dividend John, Dreamer, and Dividend Daddy, and they post like, oh, I made 5 grand this month, or I made 7 grand this month. I made whatever the number is, 6,800 or 9 grand, and you just look at those accounts going, wow, that's very inspirational knowing that it can be done. And like you said, that 46 cents in the beginning doesn't sound like a lot, but just keep going, just keep going.
mhm. Yeah, yeah, it's very important. Like I said, maybe everybody has a better circle that I do. A lot of people that I'm in are like the quick and speculative investors, the Game Stops, the cryptos, the stuff like that, where you can go up 30% in 2 days or something like that. My stuff never does that, but my
Right.
stuff does pay me for not doing anything. So like
Yeah.
even if I only made $200 last year, I don't even know what I made last year. Last year in my retire early account, I ended up making $307.21, but that was a 49.8% increase from the year before. And that's what I
Yeah.
mean. Like like imagine making 49.8. So basically 50% more from your day job, where one year you're making, 100,000, the next year you're making 150,000. Like you're just like, okay, like I can do this. Like that's good for
Mhm.
me. And like I said, those numbers are going to get bigger. I'm not going to expect to make 48, 50% more every year. But then the next year when I'm making 500 or 700 or $800, and then the year after that when I'm making $1,600, like then you
The,
start
the,
seeing how
the
it goes.
snowball.
So, yep, exactly, yeah. So, it's if you guys do have any friends or anybody that does, make fun of the start of the journey, just keep at it. You'll make them jealous pretty quick. When you're making all this money, just sitting there doing whatever you like to do to pass the time, and you're making all this money, it'll be worth it. So.
Exactly. Couldn't agree more. You also just mentioned like the projections. Personally, I don't really focus on the projections too much. I just kind of I know I keep adding shares. The dividends are keep going to keep going up. So I don't again maybe the exact opposite of you and your overthinking is that I don't overthink anything.
Yeah. And that's probably better for your health, honestly, because there's a lot of things, not just fitness or finance related, fitness, everything I do, I just overthink often. It helps me make calculated decisions though. Like I said, if I can get over that informational paralysis where I, don't make a decision, and I finally do make the decision, I'm 99.9% confident it was the right decision because I have all that information. I gathered it. I took my time. I don't do impulse anything. There's no impulse purchasing here. There's no like I really want a Tesla. I've driven Teslas 10 times. They're phenomenal cars. They're really, really, really fun. Um, but I have a car. It's got 46,000 miles on it. It's a Subaru. It'll last a long time. Like I don't need a new car. I'm just like, would this help me along my dividend journey? Would paying a $500-600 car payment when I don't have a car payment would that help me? It wouldn't, because that takes out money from my dividends. And like, it's $600 a month now, but $600 a month now times 22 years worth of compounding at 10, 11% per year, plus the whatever the market return is. Like, that's where you start factoring in those things. Like, the decisions you make today can really help or hurt you in the future. So
For sure, for sure. I just also want to mention, it's been mentioned here on the podcast before about, going to a gym, and starting to work out day one. And it's the exact same with dividend investing. You made the point. Day one of working out, you're not going to see any like massive gains or results. But yeah, by the end of 30 days, you might start to see a little bit. And then by the end of, 90 days, you're going to see a little bit more. By the end of a year, you're going to see a fair bit more. And then, yeah, like you said, at the end of 10 years, all of a sudden, look at me now, right?
yeah, it's really the ability to step back and look back, because in the fitness journey and the finance journey, you almost never even see the progress from day to day. Like, looking today, and if I look back at yesterday, like, I don't, there's nothing I notice. I don't feel any different. I don't look
Right.
any different, whatever. That first day you go in, you're clueless. You're like, I don't know what this machine does. Am I do does this lever move this seat, or what's it do? You don't know anything. You're sore, you're scared, like all the things. Same thing. I mean, maybe not sore. I hope you're not sore doing dividend investing, but yeah, so it's one of those things where like it's the same. Like, it starts small. I don't realize I make any gains on a bench press or a squat or a deadlift or any of those things until I look back and be like, wow, I'll see a Facebook memory or a video in my phone or something where I was struggling to deadlift 315 and now I do 545. Like, one of those things where you're like, wow, like that's ridiculous. The same thing on dividends, right? Like,
Yeah.
you're not going to realize like, oh, this month I made 3 cents more than last month. Like, nobody cares about that. It's all about looking at it 4 years. And then you look back at that time. You're like, remember when I was making 51 cents a month and now I'm making $500 a month?
Yeah.
And it's just the look back, the 10,000 foot view, where that's when you can really start to see that growth and understand and appreciate the process, and understanding that you'll get there eventually. Just keep at it.
Yeah, great advice. This has been another great conversation here on the Passive Income Podcast. I truly appreciate your time this morning, Troy. And yeah, that's just keep going.
Yeah, I mean, I think a lot of the people on the podcast say the same thing. Just keep going, get started. I know it's the cliche, you got to start somewhere, like all that stuff. But as I get older, I'm not old, but as I get older, I always start to say the same thing that a lot of people before me have said, and there's a reason that everybody says the same stuff. It's because it's true.
It's
Getting
true and it
started,
works.
scary. Yeah, it works. You got to get going. Like, just keep at it. There's plenty of resources. In Twitter, on YouTube, on Facebook, like all these things, on just online in general, where you don't necessarily go there and follow somebody's advice blindly. That's never a good idea, but it's good to get a bunch of different points of view, which is why I'm on Twitter, which is why I'm on Facebook, because like I do want to see what metrics do other people value, and why do they value those things, and like, has it worked out well for them, and like maybe I can steal one of those and add that to mine and just make me an even better investor. And then I see people that are, 18, 19, 20 years old that are starting investing. Everybody always wishes they started sooner. Like, I actually downloaded Robinhood back in like 2016. And then I think I pulled up, I don't know, let's just say Apple. And I was like, man, this is 100 and something dollars. I was like, oh, I got to put real money in there. That's scary. And then I just closed the app. I was like, I'm done with this. Like, that's
Yeah.
scary. But had I, I was like, hey, I have an iPhone. Like, I do all these things. Like, Apple's a great company. Apple has the ecosystem. Apple has brand recognition. Apple's worldwide, like all these things. And if you would have just but bit the bullet. And the great thing now is fractional shares. I know a lot of people like to buy like whole shares all the time, but fractional shares, you can get started with like $1, literally $1. Put $1 in there. You're literally going to be making pennies in dividends, but that's pennies more than you made yesterday, and
Yeah.
that's pennies for free. So that my wife makes fun of me, and all my friends make fun of me when I'm walking around like parking lots and stuff. I will look for change and I will stand up and yell dividends as I pick it up. I'll find a penny. I'm like, I found a dividend. So it's one of those things. It's basically the same, right? I mean, I don't really hold any shares of a company or whatever, but that's free money. Like, I didn't have to ask for that penny. I just found the penny.
Yeah.
I think last year it was like $17.87 worth of change that I found throughout the year, which I don't really go many places. Like, I work from home, so like that's pretty good. Like, I just go to the gym and Thunder games, and I found almost $20. That's pretty cool.
Awesome. Again, thank you so much for your time. And if you're still watching at this point, please hit the subscribe button.
It's
Those are the rules.
mandatory at
You're
this
still
point, right?
here. Pardon
Yeah,
me?
it's mandatory to hit the subscribe button if you're still here.
Exactly.
Yeah.
It's an hour. You've spent an hour of your time with us. Just hit the subscribe button.
Yeah, it's free. It doesn't cost you any of your dividend. Just subscribe to the channel. You'll appreciate it. You'll learn so much more than money can ever pay for.